personal tax calculation. Okay, we learned how to calculate the tax on our income, both federal and provincial, using marginal tax. Okay, and remember in the question we said do not consider tax deductibles or tax credits. Okay, the tax that we calculated in the previous example and previous topic was just tax of your employment. Okay, let's say you have investments, you have rental income, you have your business. These also generate you income, generate you money. You need to pay tax on them too. Okay, government won't let you go. You need to pay tax on every single penny or cent you make in Canada. And so in this topic, we're going to learn about different types of income, then about tax deductibles and tax credits. Okay. When you're filing your tax on, in Canada, we do it it starts late February and continues until April. Every year, any individual who works in Canada needs to file a tax. Okay. But what factors or what components we need to be fully aware when we're filing our tax? Okay, let's say we're gonna file a tax. Okay, we need to calculate our personal tax. The first step is calculate total income, like everything you have earned in the previous year. Okay, total income is sum of employment income, so you work somewhere and they pay you. Business income, you have your own business, or you work somewhere and you are also self-employed. Especially these days, everybody needs to have 2 jobs to, survive. Killing. So total income is sum of employment income, business income, investment income. If you have invested in something, let's say bonds, equities, and different dividends, different types of investments, you get income. You need to pay tax on them too. And investment income plus capital gain. Capital gain means whatever you earn from stocks. Okay, common shares, when you trade common shares. So total income is sum of these 4 components. Okay, but we need to consider 2 points when calculating total income. Point number 1, when we calculate investment income, okay, there are 2 types of investment income: dividends and interest income. You get dividends when you invest on preferred shares, and you get interest income when you trade or invest on bonds or debentures. Okay, your interest income, you need to fully report your interest income. There is no tax treatment on interest income. Okay, this is very, very important point. There is no tax treatment. There is no credit. There is no deductibility on interest income. You need to report all the interest income you earned from bonds. But for dividends, there is interest. There is tax treatment. Okay. So to calculate in your investment income, you have interest income plus gross up your dividend income by 38%. So you have your dividend income multiplied by 1.38. Why? We will get it in the 4th step of this topic. Okay, this is slide. I'm gonna explain why. Because government give you tax treatment on dividends. Okay. Point number 2, when calculating total income, just 50% of your capital gain is taxed. Okay, so your interest income, fully taxed, no tax treatment. Dividends, you need to gross it up your total received dividends by 38%. So multiply that dividends by 1.38. Your capital gain, what is capital gain? Your stock is, you bought your stock at $10. Now it's $25. Okay, this 15% is your capital gain. Okay, you only report 50% of your capital gain to the CRA, or Canada Revenue Agency. Okay, so these 2 points are very, very, very important, and you are gonna question, and there are 2 questions just from this 2 little points. Okay, again, I'm gonna repeat it again. Your capital gain, just 50% of your capital gain. Okay, your dividends, gross it up by 38%. So multiply your dividends income by 1.38. Your interest income, fully taxed, no tax treatment. Okay. So we sum up all those 4 components: employment income, business income, investment income, dividends and interest income, and capital gain. Okay. We now have the total gross income we made last year. Okay. Step number 2. Now is the time that tax deductions comes in. Okay, let's say the total gross income from like all 4 sources are $80,000. Okay, now second step, we need to deduct some tax deductibles. So tax deductibles duty is reducing your taxable income. Okay, when tax deductible comes in, your total, if your total income is like, the higher total income you have, the more tax you pay. This is the simple thing that everybody knows. Okay, the higher income you have, the higher tax you pay. Tax deductibles duty is reducing the total taxable income. So it tries to reduce the total income you made last year, so you pay less tax. Okay, what's the most like common tax deductible? It's RRSP. We're gonna talk about RRSP in future. Okay, a little bit in this chapter and more of it in the next chapter. But RRSP is the most common tax deductible tool. Each year you got, like, depending on your income, you got 80%. You have a room called RRSP, 80% of your gross income. Okay, you can transfer money to your RRSP and deduct that when you're filing tax, and you can deduct that money that you have transferred to RRSP, and you can reduce the total taxable income you had. Okay, so the second step is we have total income minus tax deductibles. Okay, so now we have new taxable income. Number 3, now it's time to step 3, it's time to calculate the tax. Okay, how do we do it? Now we do it exactly like the previous example that we had, marginal tax. Okay, let's say our total income was 80,000. Our RRSP room, we have transferred 10K to our RRSP room. Okay, now our taxable income is $70,000. Step 3, we're going to calculate gross tax on that $70,000. How? With using marginal tax rate brackets. Okay? So if our salary is 17, our taxable income after tax deductible is 17,000, we're going to just use the first three tax brackets. The 17,000 will go through those three tax brackets, and we're going to calculate the gross tax. Okay? Why do I say gross? Because I'm going to go now to step number 4. The reason is step number 4. The term tax credit comes in. We do have gross tax. Now, we CRA or government, different governments offer tax credits to all individuals in Canada. We're going to use that tax credit to reduce the gross tax we owe to the government. So remember, so there's difference between tax deductibles reduce the taxable income, reduce the total income that you need to pay tax on that income. Tax credits reduce the total tax that you need to pay or you need to pay to the government. Okay, that's why lots of people get tax refunds, because they apply lots of tax credits. Most of them should be refundable tax credit. Okay, so step 4 is gross tax minus tax credits. Whatever you have, governments offer individuals different types of tax credits. Okay, but there is very important point about dividends. Remember dividends? We grossed up by 38%. Now, government's tax treatment for dividends. Government offers you 15% of dividend income as your tax credit. So, government grossed up your dividend income. Okay, so let's say you have earned 1,000 just on dividends. Okay, government says gross it up by 38%. So you're gonna get 1,000. When you gross up that 1,000, it'll be $1,380. Okay, now government. Why did government gross it up? Because it wanted to give you more credit. Now, 15% of that $1,380 is your tax credit. Go and deduct it from gross tax you have. Okay? Now, you should fully understand and absorb the steps, the calculations of this personal tax. Okay, we started with different types of income. We had 4 types of income. We had 2 subpoints about 3 subpoints about interest income, fully taxed. Dividends income, grossed up by 80%. Capital gain, just 50% of capital gain is tax. Another point. Oh, I was going to forget about it, but another very, very important point. Okay, dividends and capital gains are taxed. There are tax treatments on these two. Okay, only and only if the issuer of these stock and dividends, okay, are Canadian. So if they are non-Canadian corporations or firms, there is no tax treatment. Remember this. Nothing. There is absolutely no tax treatment if the corporation is non-Canadian, so from out of Canada. Okay? This was the point that we needed to understand. So we now fully know the 4 crucial steps to calculate the our personal tax on in March of each year. Let's get to the example to clarify more of these 4 steps. Okay, let's get to it. Challenge to learn the personal tax calculation, that those 4 steps. Okay, this example is to absorb and to understand those 4 steps. Considering the following table, what's the net tax payable question mark? I don't know why did I read like that, but net tax payable, not gross tax. Okay, we do have some information there in the table: employment income, dividend, Canadian corporation dividend, non-Canadian corporation. Try to calculate it first. You know those 4 steps now. Okay, using those 4 steps, try to calculate this net tax payable. If you can't right now, no worries. Just continue this video with me. Okay, but I would be more happy if you could go to that previous slide and calculate it yourself first. But let's get to the answer if you're too lazy to do it yourself. Step number 1, we sum up all the income, total income. Okay, we find out total income. We do have employment income of $60,000. We do have Canadian dividend income of $7,500. We gross it up by 38%. So we multiply 7,500 by 1.38. Plus, we do have dividends from non-Canadian corporation, 2,000 dividends. There is no treatment on that. Okay. Then we do have bond interest income, no treatment on interest income. So plus 3,000. Plus, now we do have capital gain selling stock. Okay. How much is that? 4,000. Only 50% of that capital gain is, you need to report that. So we multiply that 4,000 by 0.5. Plus, we still have rental income. So you have a property, you have a condo, I don't know, you're renting that condo, you need to pay tax on that too. So plus 20,000 on that. So we calculate total income of $97,350. Now, step number 2, we deduct tax deductibles from that total income. What's the famous tax deductible? RRSP contribution. Okay, how much RRSP contribution we have? 10 grand. So 97,350 minus 10,000 equals $87,350. Step number 3, we calculate gross tax calculation. We calculate gross tax. Okay, $87,350 goes through the first three tax brackets, which rates are 20.05, then 24.15%, and 29.65%. We calculate the gross tax. The gross tax will be $21,341. Last step, net tax. How do we calculate net tax? We deduct tax credits from gross tax. What tax credits we have? We have dividends. So 15% of dividends, so 15% multiplied by 1.38 multiplied by 7,500. Okay, we do have that tax credit. We do have so we grossed up the dividend income. Okay, now 15% of that grossed up amount is your tax credit. We also have other tax credits. Ontario job training tax credit, $265. We're gonna sum that too. We do have Canada training tax credit, $300. We're gonna sum up that too. So taxable income, gross tax minus these three tax credits, dividend tax credit, Ontario job training, and Canada job training, equals to your right answer. Great. I think now you fully understand those four critical steps, okay? If you haven't understand it yet, if you haven't, by understand, I mean fully absorb it yet, just please go and watch it again. Like start it over, okay? You have time. You have lots of time. You need to, as a mutual fund sales rep, the first two topics was informative topics. I mean, I think some of the complications in your mind have been solved because I was always like, what's marginal tax? Okay, what are tax deductibles? What are tax credits? What's RSP contribution rule? What's interest income, capital? These should be solved on YouTube. Okay, great. Let's get to the next topic.